Interpreting the balance sheet. Firi has a photocopy and print shop. She wants to purchase new equipment, but her husband doesn't think they can afford it. Are you in a similar situation? Maybe you're thinking about taking a loan to expand your business, but you're not sure if it's the right decision. Your balance sheet can help you. In this lesson, you will learn what a balance sheet is, how to read and interpret it, how to use the balance sheet to assess the financial health of your business, and what actions you can take to improve financial health. What is a balance sheet? A balance sheet is a snapshot of your business's financial health on a given day. It gives a detailed picture of what your business owns, what it owes, and who it owes it to. At a high level, a balance sheet shows how much your business is worth. How to read a balance sheet. Let's have a look at the balance sheet of Firi's photocopy and printing shop. This balance sheet was produced as of December 31st. There are two sides to the balance sheet. On the left are assets, and on the right are two major categories: liabilities and owner's equity. The balance sheet needs to balance. This means the value of total assets should equal the value of total liabilities and equity. If a balance sheet doesn't balance, there is something wrong with the financial statements. Now take a closer look at each section of the balance sheet. Assets are things your business owns that have value and are used for business operations. There are two types of assets: current assets and long-term assets. Current assets are things that can be converted into cash within a business cycle or a year. Cash includes cash on hand, money in bank accounts, certificates of deposits. Cash is the most current of all assets. Accounts receivable are the amounts that customers owe to your business as a result of credit purchases. These are normally turned into cash within 30 to 60 days. Inventory includes raw materials, work in process, and finished goods that can be used or sold relatively quickly for cash. Other current assets include prepaid expenses and deposits. Long-term assets are items that take longer to liquidate and turn into cash. As a rule, assets are usually considered long-term if they are held for more than a year. Examples include land, buildings, and machinery. Many long-term assets lose their value over time. The cumulative amount originally spent to purchase long-term assets is shown as the gross value. What we call the accumulated depreciation expense is really the lost value. The remaining value of a long-term asset is calculated by subtracting the accumulated depreciation from the gross value. Total assets is the sum of the value of all current and long-term assets. And where did your business get the money to buy all these assets? Let's look at the other side of the balance sheet. These are the liabilities. Liabilities are what your business owes to others. The liabilities section indicates where your business gets the money to finance its operations. Just as with assets, there are current liabilities, those items that need to be paid within the next 12 months, and long-term liabilities, those that will only be due after a year. Current liabilities include accounts payable, that is, money owed to suppliers, and the portion of your debt that needs to be paid back within a year. Current liabilities also include accrued expenses. For example, taxes you know will be due but you haven't paid yet, or other expenses for which you haven't received an invoice yet. Long-term liabilities are debts that will not be due for more than a year. The last section of the balance sheet is owner's equity. This is the net worth of your business. Owner's equity is made up of two parts: the amount of money you've invested in the business and the earnings that have been retained since you started operating your business. Retained earnings includes the net income that has accumulated over the years, and it keeps adding up. Owner's equity is reduced when you make a withdrawal. It will also decrease if there's a net loss in any period. Now, add the total liabilities and total owner's equity together. The amount is the same as the total assets. Let's check what you've learned so far.